Hello and welcome to Trading Hour live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Reema Tendulkar. Hey Reema, it's a fresh news series and we are seeing that recovery that has coming from the lows as well. So we did fall below that 26,000 mark, but now back above that. In fact, the Nifty is now seeing gains of 109 points. Bank Nifty also briefly got into the green. Again, it's basically a green and red tick that we continue to see on the Bank Nifty as we speak. But a lot of these names have recovered from the lows of the day as well. So you have something like Tata Motors, which is at the day's high. We have Adani Ports, Infosys, ITC, Sun Pharma. All these names are contributing to the recovery that we're seeing from the lows. But of course, that remains to be seen which way things go. For now, Nifty Energy Index, that's one of the top gainers that we are talking about. Nifty Metals continues to be an outperformer. Oil and gas space in focus, pharma, infra, IT, all of them are doing well in trade. And we do have a lot of earnings to talk about. And not just earnings, it's been a very, very busy week otherwise as well. So much happening, be it the SEBI norms, be it Trump's commentary now and then on the trade deal and Russian oil imports as well.
Indeed, I think the big reaction that we're seeing in the markets, the positive reaction, is Donald Trump's latest statement where he underlined that he will do a deal with India, a comment that has sparked optimism. So far, it's been a steady morning of trade. The Nifty is holding above 26,000, a gain of 100 points. The Sensex is up 300 points, just about 100 points shy of that 85,000 level. The Nifty Bank is flat for now. It's about 350 points away from its all-time high levels. In terms of stocks, big moves seen in the likes of a Blue Dart, a SAIL. You've got an Adani Green, which is up close to about 7.5%, Godavari Power and Ispat. And on the way down, profit booking visible in names like a Car Trade Tech, which was the big mover of yesterday. But in fact, let's talk about Blue Dart. That's rallying on the back of a strong performance. Mangalam joins in with the numbers.
Well, it's a good performance that is coming from Blue Dart this time, but the street is more excited about what lies ahead as well, because the second quarter typically is seasonally the weakest for all these logistics companies, especially the parcel ones. And more importantly, this quarter was also impacted by, extremely high rains and flooding in many parts of the country. So all of that, despite that, the company did fairly well. There was a dynamic situation and we saw 7% revenue growth, which is obviously not double digit or something that we've been used to seeing from Blue Dart. But despite all of this, the operational performance was fairly strong. They had about 15.5% jump in the EBITDA. Margins did well, and as a result of which there was a near 29-30% jump in the net profit as well. The important part though, and why the street is celebrating, is because there are important triggers in the next couple of quarters. The quarter that we're currently in is seasonally the strongest for Blue Dart, so things are only likely to be a lot better from the second quarter to the third quarter. And the fourth quarter, come Jan 2026, remember every year Blue Dart takes an annual price revision, and this is something they informed the exchanges about a month ago as well. So from Jan 2026, which is the fourth quarter, there will be a price revision of 9 to 12%. So that also will kick in. So second half likely to be a lot better. And the second quarter, which is seasonally weak, in which the company did fairly well on the operational front as well. And add to all of this, the stock over the last 1 year, despite the up move that we're seeing today, is down by almost 20%. So the stock hasn't seen a big rally either. All of that leading to the up move that we're seeing in Blue Dart right now.
12.5% higher on that one, Blue Dart. That's the stock on our radar.
There's one interesting company which will be a peer to Blue Dart, that's Shadowfax. And they're expected to come up with the IPO in the next couple of months now. And that's a company, because I was just reading the DRHP for interest, it's more like last mile. So if you order from a Myntra, you order from a Nykaa, they will deliver it. But where they're different from the others is they are entrenched in quick commerce. Quick commerce. So while quick commerce has their own in-house delivery center, some part of it where they can't fulfill it themselves is outsourced to Shadowfax, and that's a company which has been growing very well.
Okay, all right. Let's talk about earnings now. IT firm Happiest Minds Technology reported its Q2 numbers. The company reported constant currency revenue growth of 2.3% sequentially, while EBITDA margin dipped 120 basis points. Reema caught up with the management of the company and began by asking about the outlook for the second half of the year and the guidance for double-digit revenue growth for the full year. Listen in.
We had guided that we would do double-digit growth for the current year, and I would say that we are on track to meet that goal. Our pipeline at the end of Q2 was much higher than what it was at the beginning of the year, which should contribute to growth in Q3. Now, some of the initiatives that we undertook, transformations that we undertook last year, have started paying dividends. If you look at our NN initiative, where we broke up the NN sales team, the sales team into NN BDMs and EEN BDMs, that's beginning to pay off in terms of the new logos that we closed. We had 30 new logos in the first half of the year that we expect will contribute to growth in the second half, as well as contribute $50 million over the next 3 to 4 years. GBS was other transformation that we had started, and we have, it's come along really well. We've done $4 million for the first half of the year. We should do our goal of $8 million for the current year. They had broken even last quarter, and they've started showing profitability, so contributing to the bottom line as well. And 22 of the use cases that we have implemented, we realized are replicable sales, which we are taking to other customers as well. And we expect to get another $50 to $60 million from these use cases over the next 3 to 4 years. So not only will they contribute to the growth in the second half of the year and to this year, but we also look at them driving growth for the next 3 to 4 years, based on which we are confidently saying, earlier we had said that we will do double-digit growth for next 3 years. We're increasing that to 4 years now.
Venkat, can you explain the margins? I believe there was a wage hike impact which hurt margins this time. What was the overall contribution and how were you able to offset it? The INR depreciation and other factors.
So to start with, yes, we were one of the very few companies who had given the pay increase effective July of this year. So that has had an impact. We could set off part of that through improved efficiency. Our utilization is at an all-time high, or I should say high over the last 3 years of 80.7%. Our attrition is trailing down to 17.4%. Both of them have had a good role to play in margin management. Interestingly, our gross margin for that quarter has gone up to 37.2%, aided of course by help with the way the rupee has moved versus the dollar. So it has been a quarter where we had some benefits, most of which has been plowed back into the business in terms of investments in GBS, business services, and the new sales engine that we have put in place. The new sales engine is beginning to fire. We have assigned 30 new logos with the potential of anywhere between $50 to $60 million in the next couple of years. GBS has not only broken even, they did that last quarter. They're beginning to perform on that same basis, and we are looking to get back to the profitability numbers that the other BUs are showing, are in fact better from that standpoint. So hopefully we should be able to manage the cost increases that we've taken in through efficiency and cost management, and also improvement in profitability of GBS and the new sales engine starting to fire. Obviously, I would not complain if we get some benefits from the exchange rate environment, but that's something which we don't have much control about going forward. But all told, on a margin front, we are hopeful of maintaining the 20% plus EBITDA guidance. Operating margin at 17% plus. We have done 17% this quarter, and YTD 17.2%, which is in the striking range of what we have been planning for, targeting for the year.
Generative AI, you said $8 million in terms of revenues for FY26. And again, just walk us through how the operating profit from here on will improve. You spoke about how it broke even in Q1, but the trajectory to get back to company averages, how long will that take?
Yeah, so that we had said about 18 months. 18 months is what I had said to come back to the same levels of profitability that we had planned for. We are down to 12 months right now after the BU started fully firing. And I would say by the end of the year, they should be at the levels that we have planned for them. But, largely then looking at them as an individual BU and the profitability, the ability for that business unit to pull through revenues into our other two units and how they work so closely with the other two business units is what is really that needs a call out. They are really helping, up efficiency, the rates that we are deriving from our customers, the work that we do for the customers on the other two BUs, which is really, I would say, Gen AI-led services. So, if you consider that, I think the payoff is bound to happen by end of the year. The rates that we get for Gen AI services, Gen AI-led services are, significantly higher than the averages that we get for higher end services like analytics and even product engineering. So that also will contribute to the way we manage our profitability going forward.
Joseph, you want to elaborate on the point that you are able to command higher rates for generative AI business? Can you put a number to it? How much higher than the overall company average? And even this, pipeline of $50 million in terms of revenues over the next 3 years. How have you arrived at it?
What we're seeing, while there's a range, on an average, right? If you take average rates, we're seeing something like 20 to 25% higher rates than the rest of the company for Gen AI related projects. So that, as Venkat pointed out, that contributes to higher margins as well. So, what we did during Q2 is to look at all the use cases that we had implemented for customers and looked at, how applicable it is within that vertical or across verticals, and then assume that, if we got X more customers over the next 3 to 4 years, given the revenues that we've got for each of those implementations, what would that turn out to be? Aggregated that, and that's how we came at around $50 to $60 million for these 22 replicable use cases.
Well, that is Happiest Minds for you, and the stock is moving up post this interaction. Basically, the company is saying that double-digit revenue growth for 4 years versus earlier they were confident of achieving it for 3 years. Now they're saying 4 years. And there are two key reasons. One, the generative AI business unit. That, based on what they have right now, they believe can generate revenues of about 50 to 60 million over the next 3 to 4 years. And secondly, they did a lot of reorganization, but they basically got a sales team, dedicated sales team. So the net new logo addition has been very strong. So that's about 30 in the first half. And that also, when they extrapolate the performance, they're saying that will again, add about 50 to 60 million in the next 3 to 4 years. So which is what makes the company confident on Happiest Minds. All right, we will slip into a break on that note. On the other side, we'll focus on the crypto market. Dilip Chinoy from Bharat Web3 Association will join in on the other side.
CNBC-TV18 presents Crypto Corner, powered by Coin DCX.
Welcome back, and joining us now to talk about cryptos is Dilip Chinoy. He's Chairman, Bharat Web3 Association. Mr. Chinoy, hi, thank you so much for joining in. First of all, since the time I've started doing cryptos, October has been called as the Uptober, but we haven't seen that turnaround this time, would you say?
Yeah, actually, Manisha, the difference this year versus the last few years and the last so-called bull run was that this year the things started pretty early, right? And there was a continuous kind of increase in prices, but very interestingly, reaching close to 120, say Bitcoin. It did have a kind of a dip, which was linked to various other factors other than the crypto, and it is very interesting. And there was a dip, and now, of course, it's around 113 thereabout. And you were seeing over the last few days huge liquidation going in. But also, what is happening is that there are new products coming out in this space. We've recently seen that, the exchange traded funds are even being extended to Solana and to other such virtual digital assets. So you are seeing this happening. You're seeing a little bit because of the price movement of both Bitcoin and ETH. You are seeing some different, challenges there in the exchange traded funds and in the spot kind of sector there. But I think the October got preponed to September, but let's see. There is a lot of currently a lot of guarded optimism going forward. But of course, what is interesting, and very recently there was a kind of analysis done that some of the largest or some of the more critical virtual digital assets are getting correlated as close to 0.87 with the S&P 500 and with the Nasdaq. So that's how it is actually moving currently. But yes, the last 2 days have been very significant in terms of a kind of
declines coming in. Well, yes. Mr. Shenoy, also comment on the kind of moves that we've seen in the global markets. I mean, there have been big names really on how, big companies are tying up with crypto companies and trying to put in more products and facilitating crypto trading, even collateral management for that sense. How are we looking at all of this progress on one side and India still waiting and watching?
Manisha, it's very interesting. If you just see the last 2 days, right? Let's not go back. Let's not talk. There is a significant change in how virtual digital assets are being looked as an asset class. Okay. The first very interesting, statistic which will be of interest. If you take Bitcoin, right? There are 21 million Bitcoins in circulation, out of which 100 companies, right, including companies such as Time and other companies. Of course, MicroStrategy is the leader in this space. They have treasuries. And these 100 company treasuries account for 2.1 million of the Bitcoins. I think 10% of the Bitcoins are kind of in corporate treasuries. Okay. You are then seeing, country after country in the US, state after state, including nationally, looking at setting up strategic Bitcoin reserves. Okay. That is slightly different in the sense that these are the Bitcoins which have been seized or which have been, have been taken from, by the law enforcement agencies and with the state, and they're creating Bitcoin reserves. But what you're actually also happening is you're seeing many new products coming out in the marketplace. For example, there's a X402 protocol, right? It's kind of like the HTTP is known as the web, right? It's a HTTP native payment protocol designed by a company which has kind of revived the old HTTP 402 payment kind of required. It allows websites, APIs, and even AI agents to request real-time payments directly through standard web payment systems, right? No subscriptions, no middlemen. And if this becomes mainstream, right, then you'll see, payment costs as 0.001 or 0.001, rupee, right? That's like less than, 0.1 paisa for a transaction. And this is a very interesting development. In the other side, you're actually seeing something interesting happen, right? You're seeing, traditional finance companies and blockchain converging faster, even as major institutions kind of, go in for tokenization of real world assets, setting the stage really for a massive transformation in digital asset space. Now, there was a very interesting study which actually came out it was done by Aptos Lab and BCG, looking at the Hong Kong market, which came out yesterday, which are saying that the Hong Kong people are looking at transiting to tokenized assets because they enable real-time settlements, lower transaction fees, etc. And if you're even seeing that there are blockchain technology continues to accelerate as a major financial, institutional kind of a capability. You're seeing products developed by HSBC, by JP Morgan, by others. The Bank of New York just very recently, has introduced, as its core service, banking as a service infrastructure, providing for a digital asset platform. So right. Banks also are getting into this. So there are multiple things happening here. You're seeing a lot of collaboration happening. And of course, the stable coins business is a totally different thing where every major financial institution is coming into it.
Oh, yes, Mr. Shenoy, there's no dearth of the newer things that are happening. But, well, as you said, most of them are still happening outside India. And October is not really October, but September did see a lot of gains coming into the market. But your point is well taken. As you say, 10% of Bitcoin being held by corporate treasuries. And then you have banks, countries actually working towards whether it's payments or tokenizations or real-world asset management that we are seeing happen in case of cryptos right now. But with that, it's time for a short break. More market talk on the other side.
CNBC-TV18 presents Crypto Corner, powered by DCX.
Welcome back. DCM Shriram is trading in the green. This is after the company reported a 71% surge in their Q2 EBITDA. But the company also announced the acquisition of 4 industrial salt companies to enhance their capacity. Amit Agarwal, Executive Director, Group CFO of the company, is now joining in. Thank you very much, Amit, for joining in. Let's start with the rationale for the acquisition. What does it bring on the table? What does it do to your existing supply chain, backward integration? And once it comes on board, what will it do to your overall financials?
Sure. So, our capacity, the caustic soda capacity, is about 1 million ton, and which means we require almost 1.5 million tons of salt. And salt forms about 20% of my cost of production. Now, in terms of the total capacity in the country, the production in the country is about 34 million tons of salt, expected to go up to about 43 million tons by 2030. And the availability of new salt mines are far and few. That is point number one. So which means that we need to assure our supplies. Second point is the salt prices. If we see last 9-year trends, they have grown at a CAGR of almost 12%. So that's the other reason. So the idea is secure our salt supplies and also get more assurance on the price of salt. Given that, the demand is going up and the availability of salt is going to get a little limited, is what we feel. So this is more a strategic acquisition to ensure our raw material.
So it will not have any positive impact on margins then?
So it will, because see, today I'm buying salt at a price, and salt, there are very good margins on salt for salt producers. So we will get salt at the cost. So it will add to the profitability.
Okay. This time around, profits were also higher because of Hindustan Specialty Chemicals that you had acquired, right? Can you give us a sense of how much was the impact? Because the EBITDA has surged quite a bit, margins are higher. Strip off that, what was the organic growth?
Yeah. So let me talk about organic growth first. So the entire growth is driven by 3 factors in the chemicals business. One, it is driven by the volumes, and primarily by the volumes, I would say. And volumes are coming from caustic soda. It is coming from hydrogen peroxide that we had commissioned last year, from glycerin sales, purified glycerin sales that we are doing. So largely these are the factors which are driving the volumes. In terms of margins, they are being driven by better product prices. Again, primarily in caustic soda, the ECUs are better. And also our cost structure, which I had mentioned the last time as well, that our cost structures over the last 1.5 years have come down by about 15 to 20%. So that is the reason why our profitability has inched up, volumes and margins. Coming to your point of Hindustan Specialty, see, the plant was acquired, or the business was acquired by August end. On 26th August is when the closure happened. So it's been just 1 month. And the business has been making losses in the past. When we, FY25 also was a loss-making year by the earlier management. So it'll take time for us to turn it around.
What's the overall revenue guidance? You've done about 10.5% in Q2. You last time told us about 11 to 14% for the full year.
So I would, say it will be more towards, in the range of 12 to 15% is what I feel for the year. Our revenue should be higher.
And can you give a color on the individual segments in terms of the H2 outlook?
See, H2 outlook, given some of our businesses are very seasonal, like sugar and farm solutions, So these will see a lot of profitability coming in, along with the chemicals that will continue to have higher profitability.
Okay. Amit, that has always been a question because you have so many segments within the business itself. Do you think someday for more value unlocking, there could be demerger on the cards? If not of all the segments, one of the segments, which is sugar, which because of government policies, because of macros, is under pressure.
So, but let's look at how the company is looking at growing the overall business. I'll come to your specific question as well. See, the company is looking at growing, and you would have seen a paradigm shift in the way DCM Shriram has been working in last 3 to 4 years. It has been making significant investments across the businesses. It is also, this year has been, I would say, year of acquisitions. We have grown organically, but we have done a lot of acquisitions, and there are a few acquisitions in the pipeline. Now, that is what the growth mantra is. That is point number one. Second, coming to your point, if you remember in March this year, we had already announced that company is exploring options of demerging its consumer-facing businesses. So we are in the process of exploring those options where we would like to demerge our consumer-facing businesses, which are Fenesta, our agri-inputs business, which is Farm Solutions, and our bioseed business. So these three businesses are in the offing. To your question on sugar, we will look at it as the board feels the right time.
Amit, great chatting with you. Thank you very much for joining in. Here is a quick note for all our viewers. If you would like to access expert-driven insights and actionable chart pattern, simply scan the QR code on your screen and subscribe to Money Control Super Pro and get daily expert calls, actionable charts, insights to power your investing decisions. Plus, this festive season, there is more reason to celebrate. 10 lucky subscribers every day will win 1 gram of gold. So don't wait, scan, subscribe, and make your portfolio shine brighter with Super Pro.
Welcome back. Well, SEBI has proposed a major overhaul of India's mutual fund fee structure to simplify charges, boost transparency and reduce investor costs. SEBI, in a consultation paper, has proposed to lower the expense ratio charged by mutual funds, and Jefferies believes that a 5 basis points cut in equity exit load related charge can impact AMC profits by 8 to 10% if implemented in FY27. To understand the impact of the proposed norms, we are now joined by Akhil Chaturvedi, who is the Chief Business Officer and ED at Motilal Oswal AMC, and Shweta Rajni, who is the Associate Director and Head of Mutual Funds, Anand Rathi Wealth. Shweta and Akhil, good morning. Thank you so much for joining in. Shweta, let me start with you first up. How significant is this move if the proposal actually goes through? We are talking about a cut in that 5 basis points fee that is charged, but at the same time, the base level charges, they have been raised. So will it be neutral for AMCs and investors, or is it largely in favor of investors?
Good morning, Sonal. So firstly, I have to say, the overall circular, if I look at it from a client standpoint, it's very good. And, over the years, we've seen SEBI has been focusing towards investor protection, investors' benefit, bringing in transparency in mutual funds, having more disclosures. And this is one welcome step, towards that again. Specifically talking about the 5 bips exit load, see earlier on, also if you see this till 2018, this used to be 20 bips of exit load oriented fees charged, which was brought down to 5 bips, and this was any which way is supposed to be transitionary in nature. This 5 bips actually goes back into the scheme. It doesn't go into the AMC profits any which way. So from an AMC profitability standpoint, I don't think it's going to have any implication. From a expense ratio standpoint to the investor, this is again a good thing because it will reduce the expense to that impact. Because earlier on, what would happen is if the base TER was, let's say, around 1.8, and then you had this additional 5 bips. Now, while there has been a reduction on the total base TER as well, this 5 bips is now included as a part of that TER. So it brings down the expense for the scheme for the investor. So for an investor, this is good because it will mean marginal improvement in the NAVs and the return that you would see. As far as an AMC is concerned, this used to anyways get passed on to the scheme, not to the AMC profitability, so should not have an implication there.
Oh, okay, all right. So it should not be that big an impact on the AMC because it was passed on to the scheme. Akhil, what's your take and how do you view these proposed changes?
So I agree with Shweta that largely the regulator is keen to ensure that as the industry scales up and reaches newer milestones, there are economies to scale, and and such economies of scale, probably should be passed back to the investors. So cost coming down in any way is always positive for the investors because the leakage of return actually drops down. Now, broadly what we see is there are two large changes from investors' perspective. The larger change, what we see is obviously the cost of trades, where we were paying up to 12 basis point as brokerage. This comes down to 2 basis points. So that's a straight shot 10 basis point benefit back to the investors. So that's a significant, I think, development, point number one. From the AMC perspective, like Shweta mentioned, 5 basis point, which was being charged in lieu of the exit loads, now goes away, right? And they're saying that they've included that in the first two slabs. But having said so, the base TRs have come down by 15 basis points. The only flip is that the statutory charges like GST, STT, all of these charges will be now loaded on the total TER and will be then eventually passed on to the investors, right? So, net, I feel that there is a marginal impact on asset management companies and distribution, but a big benefit coming to investors by way of operating costs coming down via reduction of cost on the trades.
Okay. Will this new framework meaningfully reduce the cost gap that we see between active and passive funds? Shweta, let me start with you first on this.
Yes. So, let me talk about a passive fund today. If you're investing in an index fund, most of them have, while they're allowed, I think, 1%, they generally would charge somewhere around 50, 60 odd paisa as the base TR and little add on to that. So even in the passive fund space, there's been a 15 paisa reduction now to that 1%. It's come down to 0.85. So to that extent, it's a 15 bips reduction. But your brokerage and all those costs included, if I look at even the active space now, clearly between the two fund structures, active and passive, in the active side, if you put everything together, the reduction in the TER, the exit loads going away, the brokerage costs coming down could mean somewhere around a 20 bips of reduction across the slabs on the expenses. So would it bridge the gap between the returns that you see? Definitely. The cost reduction would mean that your active fund is seeing little more reduction in your expenses. To that extent, the return differential between a passive and the active fund would go up. The costs would come down between the two. The cost gap would come down, I would say maybe around 10 paisa. And to that extent, the performance of the active funds would further go up.
Okay, and that continues to be the debate always, active versus passive. How do they perform in a market like this? So you are saying the cost would go down and active funds would perform better in that case because of the cost differential that would come by. That's an important clarification. Akhil, the other part of this notice has been that this performance-linked TER framework, which the MCs can or cannot adopt. The other one is separated execution from research cost. Both of these, will that be a challenge for AMCs, or do you think this is a welcome move?
So on the first part, obviously, I think it's a welcome move. Since we also run a large alternate book, and we see that a lot of the high net worth family offices, they prefer to have lower fixed expenses, and a lot of the performance fees needs to be paid once the manager performs. And that kind of a structure, if it can be implemented on the mutual fund structure, so definitely from HNI's perspective, I think it's a welcome move. Now, how and in what format it will happen, obviously it needs to be seen, and we'll wait for a lot more clarity. But if there can be a separate, like in alternates, we have separate share class. Here, if we can have a separate performance plan, and what kind of flexibility is given in terms of hurdle rates, the carry share, etc. But clearly there is an audience in the market who's looking at rewarding the fund managers basis their performance, and will have one more option to choose from between a fixed fees or a variable fees basis the performance. So I think definitely it's a welcome move.
Okay. Okay, all right. We have a lot more questions, but we are lacking time. So I think we'll take this forward on another show. But thank you so much for joining us today, Shweta and Akhil, and making sense of these moves. Of course, these are just proposals as yet. There's no finality. The last date for comments is 17th of November. So we'll get more updates on that by then. But it's time for a short break now. We'll get you more on the markets on the other side of this very short break. Stay tuned.
Welcome back. First day of the new series. Mangalam now joins in to bring us the latest trends from the futures and options space.
Well, it's been a good start to the November series after what was a good October. So the November series, you have the Nifty, which is doing well. You have the mid-cap index, which is doing well as well. The only thing which is conspicuous by its absence right now in terms of gains is the Nifty Bank, which is a mild underperformer. But if you look at the top contributors, despite the Nifty Bank underperforming after having done extremely well in the October series, we have the Nifty IT index, which is pulling back. We have Reliance, which is holding up ever since its second quarter numbers. And today, metals have also begun to shine ahead of the US FOMC meet. So that's a big positive as well. But we're talking about good October series. Remember, the FIs first started the September series with just 8% short positions, and that went lower to 6% at the start of October. And in just the last two series, the Nifty has added nearly 1,400 points. So that's a big positive. How much further does it go from here depends on whether it is able to cross that 26,104, 26,150 sort of mark as well. What it's also done is that now that we're comfortably above 26,000, the 26,000 put writers have taken some heart. So they are adding some positions. So maybe the support for the market has moved higher. Though on the way up, we still have resistance around 26,150 to 26,250. That's what the call writers at 26,100 are playing for. Let's see where that goes, because we do have a bunch of triggers for the November series. We have the US FOMC outcome, so a rate cut would be a positive for a lot of these sensitive sectors in the US and related sectors in India as well. Developments around trade deals. We're getting comments coming in from Donald Trump. But it's not just US, India, China will also have a bearing on the business and the remainder of the second quarter results. So I'll watch out for that. One pack which has caught my attention today is the Adani Group stocks. All of them fairly well traded and at the same time well bid as well. So day one of November series, the Adani Group stocks are seeing a lot of long positions being added.
All right. Thank you so much for joining us with all those details, Mangalam. With that, we'll slip in a short break. On the other side, we put the spotlight on Suraj Estate developers in our special segment, Under the Lens.
Welcome back. Shifting focus now to Under the Lens. Sonal is here to tell us why she's watching Suraj Estate developer. Sonal.
Thank you so much for that. Well, Suraj Estate Developers, the Mumbai-based real estate company with a strong focus on redevelopment, is on our radar today. Now, remember, the stock saw its rise of nearly 9% yesterday, but it is still down 55.5% in the past 1 year. In fact, the stock listed last year at 340 rupees a share and even now trades below its issue price. Now let's take a look at the Q2 numbers, and that's why the stock was on our radar as well. Sales value came in at 153 crore rupees, which is above the 107 crore mark last year. If we talk about sales volumes, that also improved on a YOY basis to 34,875 square feet. But collections were down sharply. They came in at 71 crore rupees. Even average realizations have declined on a YOY basis, as you can see on your screen. The company says realizations were lower because of a higher contribution from the value luxury segment, while cash collections were impacted by new projects still in early stages. Let's talk about the balance sheet side. Borrowings have jumped to 480 crore rupees, which compares with 356 crore rupees, while both cash and bank balance that has declined on a YOY basis. The company says they have 17 upcoming projects and 12 ongoing ones, with plans to launch around 2,000 crore worth of new projects this fiscal itself. But here's the concern. There's been no major launch in the past year, and operational cash flow for FY25 stood at a negative 306 crore rupees. Working capitals also stretched to around 776 days versus 532 days a year ago. In terms of shareholding, promoters hold nearly 70%, around 69.6% that is. AIFs have 0.93% and FPIs hold 1.7% stake. And also otherwise, to put things in context, let's do a peer review, right? Suraj's Q2 pre-sales came in at 153 crore rupees. This compares with the peers in this way. Sunteck Realty at 702 crores, Kalpataru at 1,329 crore rupees, Sobha, the Bengaluru-based player, at 1,900 crore rupees. Prestige, of course, is a sector leader as well. In Q2, saw 6,000 crores of sales. Signature Global, the NCR player, is around 2,000 crore rupees. So while Suraj Estate is scaling up its redevelopment footprint, cash flow pressures there. We are talking about rising debt and lagging sales momentum. They are the key overhangs. So watching out for what these new launches do for the company and whether or not they are able to scale their peers or at least grow at par with the industry levels or not.
Interesting. Thank you very much for that. Varun Beverages numbers are up for you on your screen. Top line growth has come in at just about 2%. We will wrap up on Trading Hour from the entire team. Thank you for watching. Don't go anywhere. On the other side is Halftime Report.